Most beginners lose money because they start with the wrong investment. Stocks or ETFs. One choice makes investing simpler, safer, and more consistent. When I first started, I thought picking individual stocks was the key to getting rich. I chased winners. I watched charts. I stressed over every dip. What I didn't realize was that I was making investing harder than it needed to be. Once I understood the difference between stocks and ETFs, everything changed. My stress dropped, my results improved, and my strategy finally made sense. Let me break down exactly which one is better for beginners and why. If you're new to investing, one of the first questions you'll face is this: should I invest in individual stocks or ETFs? It sounds simple, but this decision shapes everything: your risk, your stress level, your long-term results. And most beginners make this decision based on hype instead of understanding. So let's clear the confusion. First, what is a stock? When you buy a stock, you're buying ownership in a single company, one business, one management team, one product lineup, one set of risks. If the company performs well, the stock goes up. If it struggles, the stock goes down. Your success depends entirely on that one company. Stocks can make a lot of money, but they can also lose a lot of money, and the outcome is heavily influenced by factors you can't control. Earnings reports, competition, regulation, leadership decisions, market sentiment. This is where most beginners get into trouble. They pick stocks based on headlines, or social media, or what's popular right now. They don't truly understand the business, and they don't diversify enough. So one bad decision can wipe out months or years of progress. Now let's talk about ETFs. ETF stands for Exchange Traded Fund. Instead of owning one company, you own a basket of companies, sometimes dozens, sometimes hundreds, sometimes thousands. For example, an S&P 500 ETF gives you exposure to the 500 largest companies in the United States. One purchase, instant diversification. ETFs are designed to reduce risk by spreading it out. When one company struggles, others may perform well. You're not betting on a single winner. You're betting on the market or an entire sector over time. That difference matters more than most people realize. Here's the core distinction. Stocks are concentrated risk. ETFs are diversified risk. And for beginners, diversification is your best friend. When I first started investing, I believed that picking the right stock was how you built wealth. I thought professionals beat the market by being smarter, faster, more informed. What I didn't understand was that even professional investors struggle to consistently beat the market. Most don't. And if professionals with teams, data, and experience can't reliably outperform, beginners face an even tougher challenge. ETFs change the game. Instead of trying to outsmart the market, you participate in it. Instead of betting on one company, you benefit from long-term economic growth. Instead of stressing over daily price swings, you focus on consistency. Now let's talk about volatility. Individual stocks are volatile. One earnings miss can drop a stock 20% overnight. One bad headline can erase years of gains. That volatility is emotionally exhausting, especially for beginners. ETFs are smoother, not risk-free, but smoother. They still go up and down, but the swings are generally less extreme. That makes it easier to stay invested long-term, and staying invested is how wealth is built. Most people don't fail at investing because of bad math. They fail because of bad behavior. They panic. They sell at the wrong time. They chase trends. ETFs reduce the emotional roller coaster, which improves behavior. Now let's address returns. Many people assume stocks always outperform ETFs. That's not true. Broad market ETFs often outperform the majority of individual stock pickers over long periods of time. Why? Because they capture overall market growth and avoid catastrophic losses from individual failures. ETFs won't make you rich overnight, but they're designed to make you wealthy over decades, and that's the goal. Another key difference is time commitment. Stock picking requires research, financial statements, industry trends, Earnings calls. Risk management. Most beginners don't have the time, interest, or skill to do this properly. ETFs require far less effort. You choose a fund. You invest regularly. You let time and compounding do the work. That simplicity increases consistency. And consistency beats complexity every time. Now, does this mean stocks are bad? No. Stocks can be powerful tools once you understand the market and have a solid foundation. Many experienced investors use a combination of ETFs and individual stocks, but beginners should earn that complexity later, not start with it. Think of investing like fitness. ETFs are compound movements, squats, push-ups, deadlifts. They work multiple muscles and build a strong base. Stocks are isolation exercises, useful but risky if you skip the fundamentals. Most beginners try to start with isolation exercises and end up injured. Now let's talk about how to choose between them. If you're a beginner, ETFs should make up the core of your portfolio. Broad market ETFs, low-cost index funds, long-term focus, automated contributions. This approach removes guesswork, it removes emotion, and it aligns with how wealth is actually built. If you want to experiment with stocks, limit it. Treat it like a learning tool, not your primary strategy. 5 to 10% of your portfolio at most. Never money you can't afford to lose. Now let's make this practical. Here's how to get started with ETFs. First, choose a brokerage account. One with low fees and easy automation. Second, pick 1 or 2 broad market ETFs, not dozens. Simple beats fancy. Third, automate your investments, monthly, bi-weekly, whatever fits your income. The key is consistency. Fourth, stop watching daily prices. Long-term investing doesn't require daily attention. It requires patience. For stocks, if you choose to invest, do this responsibly. Only invest in companies you understand. Businesses you could explain to someone else. Hold them long-term. Avoid hype, avoid day trading, and accept that some picks won't work out. Now let's address the biggest myth. Many people think ETFs are boring, and they are. That's the point. Boring works. Wealth isn't built through excitement. It's built through discipline, time, and consistency. ETFs align perfectly with that reality. Stocks can be exciting, but excitement often leads to mistakes. Here's the truth. If your goal is long-term wealth, financial freedom, and peace of mind, ETFs are the better starting point. They reduce risk. They simplify decisions. They help you stay invested through market cycles. Stocks come later, if at all. Investing isn't about proving how smart you are. It's about building a system that works even when you're not thinking about it. ETFs do that better than anything else for beginners. So if you've been stuck, confused, or hesitant to start investing, this is your answer. Start simple. Stay consistent. Let time do the heavy lifting. That's wealth mode. If this video helped you, click subscribe. Then like and share it with someone who's just getting started.